So, good morning, everyone. I think we have a great group of panelists with us. And I think what we were going to try and talk about over the next 45 minutes with panel and try to make it as interactive with the audience as possible is really around understanding the 21st century customer. I think Deanna spoke a lot about how banking is changing and some of the things around it. And I think we've got a very interesting panel. Rather than them introducing themselves, their biographies are in your booklets. But we have a very interesting mix, and I just wanted to touch on the mix that we have before I hand over for some opening remarks. Azim runs Peer Index, which is a very interesting social reputation site and system, and he'll explain a little bit more. But effectively, it identifies consumers along the lines of their social influence. And so I think this is in the heart of how we think about the 21st century and the 21st century consumer. Interesting, you have Dan, who's sitting next to him, former colleague of mine from Deutsche Bank, ran product there, and prior to that was COO. Long experience in identifying customers and in the digital space, and now runs his own startup in the digital space. So he's, well versed in this subject. Right next to him, John Eastgate. Now, John Eastgate brings a counter experience to this, and he'll talk a little bit about that. He's actually part of an old bank called Kent Reliance, which is now called One Savings Bank, and he'll talk a little bit about his customer set and how that differs from what we're typically talking about here. And then finally, Raphael at the end is really at Tesco Bank, and Tesco Bank, for those of you who don't know, is one of the pioneers in using data and the data around the club card to really identify 21st century consumers and to think about it. So maybe what I'm going to do is I'm going to start on the left and ask Raphael to just give some opening remarks, and then we'll open it up to a discussion and then move on. Over to you.
Good morning, everybody. Thanks for having me here. So I'm offering here a perspective from a Tesco Bank point of view. I know the conversation is around financial services, but equally, I think it's important to bring it into the context of a big retailer, the third biggest one for that matter, and to really contextualize what's happening from a consumer point of view. Now, going from a banking point of view, we're clearly one of the challenger brands, mainly online. 80% of our business comes from the online channels, 20% from telephony channels. And actually, what we've been seeing through the years as we grow our product feature set, and hopefully next year we're going to be able to launch current accounts as well, is that our consumers are increasingly becoming more mobile. And by that we mean the type of interactions that we're starting to get through mobile devices in terms of actually acquiring our products and services and effectively understanding what we have from an offering point of view is dramatically increasing through tablets, mobile phones, and so forth. Now, equally, we move that into the retail scenario, and actually what we see is that Tesco customer per se is actually over-indexed in terms of smartphone utilization. What that means is that our consumers are constantly using their smartphones when they come and interact with us, and actually they use that smartphone when they can to effectively guide their shopping decisions. Now, overlay on top of this club card data and how actually we can understand what the consumer wants to ensure relevance from a banking and retailing point of view, it creates a very powerful proposition. And what I like to say from a club card point of view is that we don't necessarily focus it on trying to shift behaviors or incentivize, but actually it's about bringing value to the customer. And that's why we're one of the few banks or few organizations that across all of their product features, be that Blinkbox, the video streaming, or Tesco Mobile, or including the banking point of view, we link it through our club card data to give a further element of value and basically a reward to our customer base. Now, the interesting bit for us in the digital age is the actual emotional connection and the importance of that loyalty that the customer has. Because arguably, from a bricks and mortars point of view, loyalty is driven by an element of rationality. And by that we mean I walk around the corner, I see a Tesco store, and effectively I go there because it's closer to where I am. Now move that into the digital age, and that rationality effectively basically boils down to the fact that the consumer has multiple choices. They could equally go to Waitrose or Tesco.com in terms of typing it. So for us, the important is how do we create further value, relevance, and an emotional connection through digital tools by leveraging our club card data.
So that's very interesting. We're starting to hear three emergent themes there. The first is the use of data, and I'm going to ask the panel to comment on that in a second. The second is loyalty, which is a very big theme, and within loyalty is about identifying customers, especially customers who sit around the edge, right? So when loyalty is typically indiscriminate, that's the problem. You know, if you give a discount to somebody, it's typically your best customers are using up the discount. So what you need to do is really target loyalty to the guys around the edges. So that's sort of a second emergent theme. And the third emergent theme is customer behavior, actually, and how we start to influence customer behavior. And at Anthemis, we've invested in a couple of things, Moven Bank, which we'll talk about later, around how we influence real customer behavior from a banking context. But maybe I should ask, let's start with Azim. Azim, thoughts around some of those emergent themes?
So, yeah, from a peer index standpoint, data is the kind of oxygen, because what we do is we look at consumers' social behaviors on the social web, and we make predictions about simple things like gender and age, but more complex things like, are they likely to be interested in sports versus technology, to the most complex, which is, do they have a referral value to your business? In other words, does acquiring me as a customer bring with me a handful of other people who you'll be able to acquire at a lower cost? So there's some real value in starting to understand your digital consumer that can ultimately go down to dollars and cents, and perhaps help companies move beyond simplistic measures like Net Promoter Score to more sophisticated measures that take into account someone's social capital. I think the point about the digital consumer is that, with the exception of a few pockets, sometimes slightly older consumers and those who used to work in intelligence, everybody is social and everybody is mobile. And it's impossible to actually interact with any service today without leaving a digital trail. And the goal for a company like ours is to take those digital trails and turn them into value for consumers, and to help companies give more appropriate services to their customer. Because every time I'm mistargeted, it's a pain for me and it's a waste for the company. When I look at a business like Tesco Bank, I think they sit on an enormous asset, which is unlike a traditional bank, because Tesco knows whether I'm buying nappies or whether I'm buying beer, and can therefore start to do sensible things about understanding my life stage and the kind of financial products that I'm interested in. I've been banking with Barclays for 24 years. I'm an incredibly happy customer. Thank you to anyone here responsible for that. But Barclays does not know that I support West Ham United, and I've supported them for 24 years, or in fact since I was 8, so for 32 years. Despite putting thousands of transactions through, they don't know my football team. And that's a kind of problem that I think social data can now start to solve.
Dan, your thoughts?
Well, I think I would maybe take this from a slightly different approach. You know, if you kind of mark the start of the web as 1994 with the Netscape IPO, you know, we're kind of 20 years in. So what that means, of course, is that somebody who was 10 at that time is now approaching 30 years old. So for that group of people, they kind of have had a bar set, which is based on things like Amazon and Apple iTunes, which is now also more than 10 years old. An experience of operating and buying and consuming and searching information on the web, which is incredibly easy, which is incredibly responsive, and where the expectation is that things are easy and responsive. I think the challenge that banks face is that, you know, banks have, because they have a kind of hegemonous, regulatorily protected role, and so, yes, there's consumer choice around banks, but historically there hasn't been a choice until recently, relatively recently, to do banking services not with banks. Banks have kind of taken less urgency to the issue of customer experience and ease of use. And I think the issue now is that you have a whole generation of people who have an expectation that it should be one click to buy, like Amazon. And whether they're getting a mortgage or trying to get balance information or payments history out of their bank, they expect it to be just that easy. They don't expect to have to fill out paperwork. They don't expect to have to be trained or read a manual. I mean, I always think about the fact Amazon has something on the order of 80 million customers globally, and not one of them has ever had a training class on how to use Amazon. And maybe it sounds like a trivial, stupid point to make, but I actually think it's quite profound. If you think about what the Amazon interface is, it's actually a very complex, very functionally robust order management, preference, payments, shipping, logistics, management system. It's actually very similar to what a direct marketing company would have given its internal employees to manage a direct marketing business, except for now, in the Amazon model, the customer does all the work. And they do all that work without being trained even once. And they've done it now for 18 years. So I think the challenge that banks face is how do they recognize that when a customer goes from one type of service to another type of service, they don't make a shift that now I'm in the banking domain, and so it should be necessarily complex, cumbersome, hard to deal with. They think that buying nappies on Tesco.com or buying a mortgage, those are just stuff I buy, and I buy them online. And so I think banks need to realize that from an experiential perspective, in terms of expectation management for their client base, the competition is not at all necessarily banks. It's a whole universe of companies that provide great service.
Okay, but just before I take the slightly different view that John's about to give, I'm going to ask people a question if you just raise your hand. How many of you have been to your bank branch in the last 1 week? That's none. How many of you have been to your bank branch in the last 1 month? That would be about 5 people. How many of you have been to your bank branch the last 3 months? That would be about 15 people.
Very high.
How many of you have been to your bank branch in the last 1 year?
Now, I have to raise
That
my
would
hand,
be
which I
about
feel
a
strange
third of
about.
the audience.
I got a
Wow,
mortgage.
that's pretty interesting. And so, you know, and last question, how many of you have called your bank in the last 3 months? So actually not that far off, still about a quarter of the audience. So with that, John, maybe your thoughts.
I'd like to thank the gentleman in row 3 for visiting a branch in the last week and keeping people like me employed. As suggested, I'm here to present a slightly contrary, dare I say, Luddite perspective on the debate. And I guess that's slightly difficult in as much as it's not easy to disagree with everything that's been said. So I guess I fundamentally don't. I think there's mileage in the debate that goes beyond it, however, as well. So the inevitability of technology and its integration into everything that we do, be it financial services or shopping or anything else, and it being an integrated part of life as opposed to being something we do to enable something else to happen and considering it as a discrete component in its own right, that, you know, we know that's going to happen, so there's little point in kind of laboring that. But if I just reflect on what my organization is a small bank. We've got about 150,000 customers. We do not offer current accounts. I guess that's a really important point to make. The customer base that we have, 95% of whom are savers with us rather than borrowers, the money they have with us is money that is their savings. It's their money to do nice things with when they want to do nice things, even if nice things includes, you know, buying a new boiler out of cash as opposed to having to take a personal loan to do it. It's the money to do nice things. I'm not interested in transactional day-to-day relationships with people because I haven't got the money to compete in that space, and it would be a mug's game for me to even try. So we have a much less frequent interaction with our customer base. You know, I have a relatively small branch network which serves about 5,000 people a month. I have a contact center with about 30 seats in it based in India, which services about 100,000 calls a year. You know, by sort of high street banking standards, it's a busy day, you know, equals my year. I think the point I would bring in, though, is that the nature of our relationship and the nature of our customer base, which is older and which is wealthier and which is more predisposed and does over-index in terms of preference to visit a branch, but it also indexes very high in terms of its ability to use the internet, or less so mobile technology, but certainly using the internet. They come to us, they value the interactions with us. The highest customer satisfaction rating my organization has is from a branch where you have to ring a bell to get let in. When you're let in and you transact, you hand over your passbook and we handwrite the transaction in the passbook. You know, we don't even have a printer in the branch. It's that old-fashioned. And if I think of other experiences, I've seen a customer who put £50,000, not with my current employer, with the previous one. Something went a bit wrong. That was an internet savings account. We couldn't really work out what it was. They had £50,000 kind of somewhere, but they weren't entirely sure where, and it certainly wasn't in their account. And they said, it's all right, well, we're off on holiday for a couple of weeks now. I just want to know that you've got it because I don't trust those Santander guys. You know, so a building society that couldn't accurately put its finger on where the customer's £50,000 was considered more reliable and more trustworthy than a high street behemoth. You know, and I think if we exclusively focus on the role of technology and the web and its ability and the choices it gives a consumer, then we will miss some of the old-fashioned stuff. And I'm not an advocate of old-fashioned, but I'm saying it's a relevant part of the debate and will continue to be for a period of time yet. If we lose sight of that old-fashioned aspect of banking, then we'll only ever be having part of the discussion.
So I think and that's why I think John is so important to this discussion. That's a very important point, which is customer service and what customers value. And I think the point about customers who ring the bell and walk into the branch with the highest satisfaction rating is there because people feel valued as a customer. Deanna talked about that as well, is bringing back the customer experience, which a lot of banks have kind of forgotten about along the way as they became more complex. Dan?
Yeah, I guess I would say that I don't think that the two are mutually exclusive, right? So I think clearly if you look at the failing of financial trust over the last few years, one of the issues is that banks kind of forgot what the relationship is with customers. And I think that is a question that is divorced completely from how that service is delivered. So whether it's delivered physically by ringing a bell and making somebody feel comfortable that way, obviously that's a model which doesn't scale for a Santander, and the percentage of the pie that will be interested and ultimately willing to pay for that service will be smaller and smaller over time. But I certainly agree that there will be a segment that's not, that's not insubstantial, that will exist for a long time, that will be willing and will want that sort of service. But I think the key question is, how do you deliver trust, high-quality service at scale using technology? And, not to beat it at horse, but I think that's part of what Amazon does well, right? Or Zappos does well.
Yeah, and I think it's very interesting. You take Amazon as an example, but if you look at what Fedor in Germany have done, or Moven, or indeed Simple,
great examples,
is actually all about peer-to-peer. So actually, where the discussion is going on amongst these customers is in between customers, where they discuss products and actually they become your best spokespeople if they're happy customers, because they actually talk to each other. And so there's this kind of network effect, which I guess is part of what Peer Index is all about, because that's where the influences are. Let me open it up. I'm going to pass you a microphone there, so apologies. Take that down to you.
I'm probably setting myself up because I'm the next speaker as well about trust. Are we actually mixing trust and convenience? And I think that goes to the play with Amazon. Integralis have done a recent survey that says generally we don't trust anybody on the internet, and particularly Amazon. I think we're looking at, do we mix trust and convenience in the wrong way?
Well, isn't trust is something that exists within a consumer's mind. So whatever the drivers of trust are the things that ultimately trigger that sense of trust that a consumer has. And perhaps it's the convenience of Amazon that lets us that creates that sense.
But
of trust.
I don't agree with that. I mean, for me, Amazon is all about trust. I know that when I order from Amazon, I can return the thing and get a refund. So I'm never worried about ordering anything on Amazon.
And it will show up.
And it'll show up.
Yeah.
Things will show up. If it doesn't show up, they'll give me a refund. If I don't like it, they won't ask me any questions. Amazon, I think, I think I wrote something on this. Amazon is like, the problem with Amazon is they've cornered the market for selling branded items on the internet, because nobody can really compete with them.
No one can compete.
Right? And somebody tries to, like Zappos, they buy them.
Yeah.
Because Zappos was all about customer service and trust. And so they're starting to corner that, because the minute you get into branded items, buying branded items from Tesco or buying it from Amazon is the same, which is why a lot of customers walk around Tesco with a smartphone, as Rafa talked, take a picture and check what the price is on Amazon before they buy it. And that's what people face. I mean, I think that's where we're going. Questions?
So there's moves by the UK government to free up data from certain industries. So they're looking at current accounts, credit cards. They're also challenging the supermarkets. How does that change the game when the data no longer sits in these huge CRM databases, but is passed back to the customers? What does that change?
Maybe Rafa.
So I guess the first thing I'd say is, what are you going to do actually with that data, right? So we keep on hearing organizations that it's all about data mining, but actually more often than not, you omit what you're going to do about it. And the reason why that's important is because when you put that into the retail world, and if I asked here the same question that was asked before, how frequently do you go to a retail shop, be that Sainsbury's, Tesco's, or whatever it is, I might assume that it will be slightly more frequent than what you would typically go to a bank branch. And the reason why I'm saying this is because you utilize that data then to actually be relevant from a financial services point of view, to effectively be offering more dedicated or relevant products and services. And further to that, I'd say that if you look at the specific example of Tesco Bank, if you're a Club Card customer, you have the opportunity to effectively get a specific discount regardless of the type of product that you will be going to, except from a credit card where it's more focused around rewards. So does it really change the dynamic when that data is released into the marketplace? I guess it changes it back to the element of trust. So will the customer be comfortable that that data is released above and beyond what their expectation is? Because then that really creates a potential problem of trust. And then it's actually how you're still relevant and focused with that customer, what you're giving back to them based on that data. And that's why, for me, it's about understanding what are you going to do actually with that data. Because banks keep on talking about let's mine that data, but ultimately it's much more difficult to do something about it because you need to enter with partnerships or create an element of value to them. Fortunately, from a Tesco's perspective, we have it slightly easier because we actually have a vast ecosystem of businesses that we can take the customer back to and offer real tangible value.
Yeah.
So that's a very interesting point, and I sit on a board at Swift, and we talked about this a lot, actually, along with Dan. And you know, the question is, do banks own customer data? Do banks own transactional data? Maybe I'll just take a quick straw poll. Do you think banks own the customer data of all your transactions that you've done with the bank? Yes?
Yeah.
So small population there. No? So about half and half. There's no right answer to that. It's a debate that's happening right now. What's interesting is if you consider that in Belgium, one of the core human rights is to have a bank account and to have credit. Inherent in getting credit in a bank account is your customer transactional data. So there's a very strong argument to say that customer data belongs to you, not the bank. And the banks are recognizing that, and I think that's where the world is going to go, just to that point.
Well, I have something to add to this question about data. I mean, I think Raphael's right that it's about actioning it. And the question is, can you put an economic value to the data that you have and to the outcomes you're able to generate? And I can speak much more about the internet industry than I can about financial services, but on the internet, the idea of using data to do A/B testing or multivariate testing to figure out whether you get a better outcome by applying this data in this way or this data in another way is completely commonplace, and we do it very, very quickly, and it allows us to optimize things like marketing funnels extremely, extremely well. Now, when I look at the kind of data that we have and then clearly what loyalty cards will have, my sense is that you can actually go very, very far in improving the sort of service that you deliver, and further than companies are currently going. Again, Tesco's an exception, they do it very well. And tie that directly back to an economic outcome that you as the vendor, the company get, and a value that the customer gets. So it's, generally speaking, I think it's better if data is available for companies, and it's better for customers as well because it can then be applied correctly. The question is whether those disciplines exist within companies right now, and my sense is that they're only just now starting to build those disciplines.
Okay, so while I'm walking over, I just to hand that microphone over, I just say that one of the themes that we touched on was behavioral and how data changes behavior. And just before you ask your question, maybe just some thoughts. I mean, how do you think in the future we're going to use data to change customer behavior? Because it's one thing to target products to customers, the other is really to change customer behavior, which is very critical to financial services.
I think it's really challenging for incumbents because incumbents don't necessarily want to come out and tell you that you're on the wrong insurance package, right? And that's normally the role where you look for an innovator to come in and say, here is a new service offering. And we only have to see behaviors around mobile phone insurance and PPI and so on to see that large companies have never really aligned themselves with continually trying to give exactly the best product to their customer. And that's sort of antithetical to the way, say, Amazon works, where their service has just gone better and better and better year after year.
So maybe, John, do you have a thought on that?
I think I find this very difficult because I feel conflicted because I spent 5 years working for Experian, so kind of data was my life for 5 years, and now I'm sitting on a panel kind of trying to express a contrary view. I think from an FS perspective, the difficulty I see emerging with the use of data is to tread the conduct authority line, which is one that says consumers cannot be, my word, duped into purchases as opposed to making conscious decisions about purchases. We're moving into a financial services environment where it's not so much caveat emptor, and if my Latin was up to it, I'd tell you what the opposite of that was. But there is basically the consumer will be increasingly absolved of responsibility for the purchase decision that they make, and the risk will reflect back instead on the financial services firm that is selling that product, even down to the most basic of financial services product. And those of us who are practicing in the sector will know that the extent to which we're having to bend over to sort of meet the regulatory requirements these days is truly astonishing. And so I'm still struggling in my mind to correlate the use of data to improve the offer and the service proposition that a customer gets with not inducing them into buying a product that they might turn around in 1 to 10 years' time and say, I don't actually think I wanted that, or more specifically, I don't think that actually was specifically appropriate for my needs.
So
it can be done. I'm not saying it can't be done. I'm saying there's a very careful path needs to be trod, and it's more sensitive at ground than it was 12, 18 months ago, pre-PPI and all the mess that the FS industry's got.
So rather than buyer beware, it's seller beware at that point, right?
Absolutely.
So Dan,
Look, I mean, I started my career at the PC company Gateway, and Gateway is a company which, over a glass of wine, I can tell you how they lost their way. But for the first 5 years of my career, Gateway was kind of very true to its original mission. And the mission of the company was, almost kind of messianic in its zeal. And the thinking was very simply that the company should make a very thin and a fair and thin profit on what it did. And that when its costs dropped, so when a component dropped, the price should drop immediately. And because it was selling exclusively through the direct channel, and initially over the telephone and then later over the web, and that's what I started at Gateway back in 1995, the idea was that literally our prices would change every single day. So if the price of a hard drive that we were selling in a computer, if it dropped by $40, the next day we would sell the same configuration for $40 cheaper. And we would deliver that value back to the customer. And we kept our margins consistent. And, that was, as more and more people joined the company, that attitude was something that was very hard for people to understand, because obviously, it's an incredible temptation when you're running a business, when you suddenly have a drop in COGS. Well, great, my margin just increased by 8%, fantastic. And the founder of the company was absolutely committed to saying, look, no, our margins will always stay the same. We know what they are, and we deliver that value back to the customer because we want them not just now, we want that customer for 15 years, because it's all about building relationship and trust and loyalty. And I think that banks have completely, they've never had that view. And I think they're so far away from that culturally. But I think that a bank that used data, to go back to your point, a bank that used data to help do that, so not just from a margin and cost perspective, but also from a relevance perspective, the products and services fit. So that the sort of PPI scandal is an impossibility. And in fact, just the opposite. Your bank would ring you up to say, you know what, mate, you're on the wrong mortgage. We've been analyzing a number of things. It'd be better for you to pay a bit more up front and over a 3-year period. If, in fact, you choose to keep your mortgage for that long before you pay it off, you're going to save £12,747. Imagine the impact that they would have. Imagine the advocate, the evangelist that they would create, and a customer who would go out and sing this story. Unbelievable. But somehow banks have just completely missed the boat on that. And
so that's
I see it very far away.
That's a key theme, which is transparency, which is another theme along the list of what we see that's coming out. Just let's take a question.
It's Gavin Slater from New Paradigm Consulting. So I think I definitely agree with what you guys are saying. But I think the issue that the incumbent banks have is not so much not using that data. I think it goes back to something much more fundamental, is that even internally, they don't even know what data they've got. Now, Deanna, when she spoke earlier on, talked about Barclays Retail, and she owned 100,000 different systems. That's the situation that the banks are facing. The incumbent banks have got legacy systems, and all this data is fragmented over many, many different systems, and they're struggling to really, pull it together in the first place to really understand what it is they've got. Never mind, how can I then use it? And I think that's much more the basic problem is really fixing that core underlying data. Once they've got that, they can then start using it in much more interesting ways.
Yeah, of course, Tesco doesn't have that problem, right? Because they started much later and they've collected data in a very organized way with the club card. And
exactly. So it's more the kind of the incumbent banks, the big incumbent banks, I think, are the ones that are going to really struggle to make that transition.
Tesco has sorted out the incredibly unsexy but critical problem, which is a single reference identifier for every customer.
Well, that's the problem we have in everything, reference data.
That's right.
Static and dynamic reference data. But question at the back.
Yeah, hi. My name's John O'Hare. I'm from Nutmeg, and I had a question about relationship building, and I guess it went back a bit to John's comment about, the customer service and that personal experience, and I was interested in your thoughts in general about how in a purely online company, what's the best way to be building relationship with customers, particularly when everything's moving out to sort of Facebook and Twitter, but you still have, confidential and personal information. So what's the best way to go about building that relationship online?
Yeah, so I have a slight view. I mean, relationship building takes time, and I think the models that we've established pre-digital still evolve. So, I can't ask you for your credit card number until we've, got a certain way down the line. I mean, it's been since Adam first asked Eve out to the cinema, right? He wasn't allowed to make a pass for a few dates. So you have to kind of establish a series of steps. But I think in the digital world, there's a huge advantage, which is that I've already told you an awful lot about me. Because if I'm a customer and I'm signing in with Twitter, or even if I'm not, there's no reason for you not to have a very, very clear picture of the kind of way you need to interact with me. So in my case, there's no point using sporting triggers in your words. You're better off using business or technology triggers. And you can see that immediately because that data is out there. And I think it provides you a very, very strong foundation for establishing those relationships. And if you go back to, Dan took us back to the dawn of time of the internet, the very earliest services that started to personalize, and they used to use technologies like Broadvision, would spend the first hour of your interaction with them asking you questions like, do you prefer cheese or yachting? Would you rather go and see a film or pet your cat? These kind of very difficult, right. difficult cognitive questions in order to figure out who you were. And actually that problem has now disappeared, because if I have your Facebook identifier or your Twitter identifier or something resembling that, I can actually just kickstart that relationship very quickly. Yep. And now the bigger challenge is, instead of building personal relationships with 50 people, you're going to have to do it with 50 million. So how are you going to find the balance between automating and having manual processes to deliver that intimacy at scale?
So this is no different from old school community banking, right? Your manager knew everybody around you, they knew your preferences, but you're just using technology to gather that data and scale it out,
right?
In some senses.
And scale it.
Huh?
And scale it beyond
and
the person.
Scale, yeah. It's essentially scale. So question there.
I'm Gavin Littlejohn from Money Dashboard. One of the questions earlier was around how data is going to be returned to the consumer. I think, and I'd like to open this to the panel, one of the key drivers here is to allow the consumer to self-serve in their financial relationships, to find a way in the absence of advice into making their own decisions with money. The key thing, though, about the data is suitability is a two-way street. And if organizations, banks, insurance companies, investment houses are going to talk directly to the consumer where the consumer is making their own decision, they really need to think about the importance of returning that data to the consumer so that they can triangulate suitability. I just wondered what your thoughts were about that two-way street.
John, do you want to start? And then we'll...
Yeah, I suppose I'd almost ask a question back and say, what's the consumer going to do with it when you give it back to them? I asked, the reason I asked the question is because we're having a conversation, and there's a, for me anyway, and correct me if I'm wrong, there's an implied assertion behind it that you've got a relatively sophisticated consumer who does certain things consciously. And I think in FS, the vast majority of the population still does a massive, massive amount subconsciously. And I know this from speaking to people who work in the money advice service, for example. People who have been in the financial services industry and gone into the money advice service, if that's not being rude to the money advice service, which it might just be, but we'll stick with that. And you know, they will have, you know, practical exercises like focus groups, and the comments that I get back are people in the MAS are terrified at the lack of financial literacy that exists within the UK. You know, so we sit here as relatively sophisticated buyers, having, you know, educated debates about financial services and about data and the use of technology and connecting them all together. And actually, for most people, it's just stuff that happens. And I have a smartphone. You know, my customer base demographically, I've got some smartphone users, but they've got like 100 quid in an account with me, so I'm not interested. My people who've got their 85 grand with me are quite happy to walk into a branch, they're quite happy to speak to somebody on the telephone, and they're okay on the internet, but frankly they'll tolerate the fact that I've got a slightly moody internet banking proposition because I give them a decent interest rate, and they're after a return because they're a sophisticated investor. So I'm not sure what the consumer's going to do when they get the data back.
It's an interesting, financial literacy is a very important point, and I think education is another key theme, which is also part of behavioral modification, gamification. There's a whole theme running through, and maybe Rafa, do you have some thoughts on that? Because I think that's, you know, what happens if you give everybody's Tesco Club Card data back to them? I mean...
Well, I guess what would that do is actually would help us bring further value. And what I mean by that is if you go right now across a retail experience and you get the vouchers, the coupons, and so forth, what we do with that data is actually give you back value, right? Because you like a specific product or a service, we give you a further discount so you can continue purchasing what you really like. Now, move that into financial services, and similar to what John was saying in terms of actually profiling the customer and helping them make the right decisions. So there's a thin red line between guidance and advice, right? So basically, based on the data that I give you, Tesco, and based on what I'm looking to do, or maybe I don't know what I want to do, I need you to give you back some parameters, and the responsibility of the financial services organization, or whichever organization uses that data, is to guide the customer to the best option possible, albeit making it very clear that the ultimate decision is up to them. So for us, it's a very clear synergy between what you find in the retail space and then when you bring it back into the financial services space. And frankly, if I'm a customer and I get value back of it, which might be guidance in terms of what do I do with an investment product? How do I basically leverage my offset mortgage better? Or what type of retail goods would I actually continue buying based on my preference or the recipe that I want to do tonight, right? So that's the extreme. So if you give me back that data in a relevant way that actually helps me make decisions faster and simpler, I'm all up for that.
See, to me, just one quick thought is, it's a little bit more complicated in my mind in financial services because your data that drives decisions around lending and all those things have a real impact on your life. And so one of the important things is that we as consumers need to make sure that the data people have is correct, actually, as just as important. That's where the transparency in my mind, and actually Zoopla, which for those of you who never, it's a property portal here in the UK, one of the things you can do, and Zoopla has the house price information of every single house in this country. It's digitized the data, but you as a house owner can go in and look at what it has on your house. And if it's wrong, you can tell them it's wrong, and you can say that I refurbished the house 3 years ago and that I spent this much money, and it'll revalue your house and give it to you, and it'll verify it and revalue your house. And so that rich data has real impact because our biggest asset typically is our house, and so it's so important to us. And so data, you know, I think data, putting it out in the domain is about transparency, making sure it's right, and as Rafael says, is to be able to use that to get a benefit to ourselves over time. Sorry, Dan. One last comment, and then I think we're out of time.
Yeah, I mean, not to make a semantic argument, I think it's really important that we differentiate between data and information. Consumers could give a damn about data, and they have absolutely no idea what to do with it. What's interesting and powerful and useful is to actually give them information. So it's data that's been synthesized into an action they can take, a decision they can make, an offer that they can choose. That's what's interesting. And so I think part of what's kind of complicated at the moment around this whole debate about giving consumers back their data is if you were to give, you know, Azim here his 24 years of Barclays transaction stuff back, well, what are you going to do with this mile-long spreadsheet? What would be interesting is that if there were a few insights that could be delivered to you along with it that might change your behavior and do something that's better for you and therefore increase your loyalty with the bank, that I think is powerful.
Okay, so I think we've run out of time. you know, there's a counter argument which is called PRISM, but we won't get into that, you know, because I think that's a wider debate. But I wanted to thank the panel for joining us today. I think they've done a great job, and round of applause for them. Thank you very much.
What? We did a great job as a panel.
A great job. Yeah, we did.